It's common knowledge that successful businesses don't just materialize overnight. It sometimes takes years of hard work before a business finds itself at the eve of an initial public filing, or IPO. But how do businesses grow from that first bright idea to a multinational publicly traded organization? Well, growth comes from, you guessed it, money. Money, or capital, is at the heart of all successful businesses. Capital is exchanged for many different financial instruments, some of which provide an ownership interest to the investee, and some of which merely provide a promise of repayment in the future. So, before capital is ever exchanged, how can potential investors, creditors, or analysts know they're making a sound investment decision? It's important for these parties to determine the likelihood and extent to which a potential outflow of capital can generate future cash flows to then either provide a return on investment or repay indebtedness. These parties need to review performance measures on a consistent basis across multiple entities. ASC 260 provides a framework for a comparative performance metric that displays income or loss available to common shareholders. It's called earnings per share, and, as the name indicates, it captures a company's profitability at the individual share level. This performance metric allows companies of varying sizes and capital complexities to be reviewed alongside one another. In this e-learning, you'll review the fundamental concepts of ASC 260, earnings per share. You'll learn about general requirements, as well as how to compute the two required performance metrics for entities in scope, basic earnings per share and diluted earnings per share. You'll also learn about required presentation and disclosure requirements. There's a lot to explore in this area, as much analysis is required for the financial instruments that may or may not need to be included in the computations. Let's start our journey.